In this video, we are going to talk about an alternative set of rules to net present value for capital budgeting called payback rules. The idea behind a payback rule is that you want your money back as quickly as possible, or alternatively, the higher an investment return is, the sooner you will get your money back. So for a payback rule, you set a limit, cap T. If you don't have your money back in, say, 5 years, it's a bad investment. If you want to rank order things, the sooner you get your money back, the better. So let's see how you calculate that using the investments we did with net present value. Well, with Project A, with Project A, the payback is 1 year. You invest $1 million today, you get $1 million back next year, and you've gotten your money back. For B, it takes 2 years, right? $2 million today, you pay back $1 million in the first year, $1 million in the second year, you're done. For C, it's a little more complicated. For C, you invest $3 million, you get back $2 million in the first 2 years. So you have $1 million that needs to be paid back in year 3, but you get $5.5 million in year 3. So the fraction of the year that it takes you to pay back is what determines the payback period for this one. So this is actually fairly easy to do on a calculator, clearing things out. Let's see, $1 million divided by 5.5 million, 0.18. So this is going to be 2.18 years. Now, according to the rule, A is the best, even though we know it's a bad investment. B is better than C, even though we know the net present value of C, the overall value of C, is higher than B. And why is that? Well, there's 2 reasons. The reason that A looks like a good investment is that this ignores the time value of money. And the reason that B looks better than C is it ignores the cash flows that you get beyond 2 years. So we can account for the time value of money, and it creates a lot of problems, by the way. This is another example. These 2 projects pay back, each of them, in 3 years exactly. But A is patently better than B because you get the money sooner. And that's ignored in the traditional payback rule. We can account for that by discounting the cash flows and asking ourselves the analog question, how much does it take to pay back the investor's investment plus foregone interest, represented by the discount rate for a project? Sooner is better. There's an upper max cutoff. So the discounted payback period, the first thing you do is you find the discounted cash flows. Now the cash flows in period 1 for all 3 of these projects is 1,000. Same thing in period 2. Same thing in period 4. Same thing in period 5. So these numbers are all the same. They're just discounted once, discounted twice, discounted 4 times, and discounted 5 times. I'm going to, that's not very good. 5 times. And I'm going to ask myself how long it takes me to pay back. Now there's one difference here. It's in period 3. So this is 5,500 discounted 3 times. And this is 4,000 discounted 3 times. But once I get the discounted cash flows, the basic idea of just adding them up and seeing when I cover my original investment is the same. So if we do that, let's take a look here. Get these all erased. What we're going to do is let's do B first. We'll do this the old-fashioned way, just adding it up. 2,000 minus 909 minus 826. Now let's do that. 2,000 minus 909 minus 826 is 265. The fraction of the year I have to wait to get this paid back, given a discounted cash flow in year 3 of 3,005, is equal to 0 0.09 when I round. Yes. So the payback period, well, let me put both of these on here. Payback, discounted payback. This was 1, 2, 2.18. This is never. This is 2.09. And we got to calculate C yet. To calculate C, I'm going to show you how to do it on your calculator. So I'm going to go to the cash flow functions. Notice that I've already got the cash flows entered here. 3,000, 1,000, 1,000, 5,500, 1,000, 1,000. Go to the net present value button, enter the interest rate at 10%. You can compute the net present value, 4171. You can compute the future value if you want. This is the value at the end of the project. The payback period, if you go down to payback period and press compute, you get the 2.18, which we calculated before. And finally, the DPB is the discounted payback period. Compute that thing, you get 2.31. So now at least this gets rid of A, but it still says that B is better than C because it's ignoring that big incremental cash flow over the last part of year 3 that occurs in both B and C. So the discounted payback period, because it ignores cash flows beyond date T, can give you bad answers. For example, which one of these two investments is better? $400 for each of the next 5 years. $300 for each of the next 25 years. What I want to do is show you how to calculate the discounted payback. Now this is just a 2 annuities, right? So what I want to know is how long an annuity cash flow, a fixed payment, takes to cover a $1,000 investment. I can do that on my calculator pretty easily. I'll just use the annuity buttons up here. So how long does it take a $1,000 investment at the present time, present value, to be paid back at a $400 rate so that we cover our investment, have a future value of 0. And the interest rate is 10%. Oops, 10% interest. I want to compute the number of periods. Okay. So this gives the discounted payback because the annuity buttons account for the time value of money. In this case, it's 3.02. For B, well, but while I'm here, let me compute the net present value of this. So these payments last for 5 years, so N is actually 5. I'll compute the present value of those payments. The present value is 1516, and the investment was 1,000. So that gives me the 516 that you see right here. Now let's do B. Same basic idea. The investment is 1,000 today. I get smaller cash flows in B. The cash flows in B are 300, not 400. So this is going to take me longer to pay back. Again, the future value is 0. The interest rate is 10%. How long does it take me to pay back? 4.25 years. Rounding 4.26. But if I account for the fact that there's not 4.25, that's the rounded number. Typo here. But if I account for the fact that there are actually 25 periods and compute the present value, subtract the cost, the net present value of B is actually much, much higher. But all of those cash flows from year 4 on are ignored. So it looks like A is better than B, even though B is actually much more valuable to an investor than A. So the payback period and discounted payback period, well, payback period ignores time value of money, and discounted payback periods ignores cash flows beyond the cutoff date. So this creates problems for both of these rules.